Well, hello everyone. Don Garman and Jackson Vickers, my regular guest on these monthly briefings, here again from Mirador Capital Partners to share just a couple thoughts with you. This may be even new news for Jackson, but I've seen some things that are causing me a heightened level of concern that I will be sharing with you all today. And then I wanted to just share a little bit of editorial around how our strategies are run or how they're positioned. So there will be a brief screen share later on, and we won't take too long for this briefing today, maybe 5 to 10 minutes, I would say. Before we get to that, I wanted to say one quick thing, which is July 5th, 2 days ago, today's the 7th, Mirador celebrated our 13th anniversary. Those of you, many of you remember, it was July 5th, 2013, when you got that phone call from us that we had sought out our own independence. And here we are 13 years later. I did a series of statistics over the weekend and the holiday about the growth of the firm in that time relative to other RIAs, which is what our space is, and relative to the places that we've left in the past. Anyway, by every measurement, it's been a incredible journey, and there's only one group of people to thank for that, and that is those of you who watch these monthly briefings, because you are the heart and soul of our business, and the core of what we come to work to do is to serve you and to hopefully create good results for you over different market cycles and pandemics and global financial crises and tech wrecks and whatever we're in now that may be changing becomes. So thank you. We will, we are three times as many people and 5 times the size as we were 10 years ago, or maybe 11 years ago. So by every measurement, the firm has grown a ton. And so that's awesome. We are ready and prepared to receive the next leg of growth should we be so fortunate to attract it. It seems like the signs are positive that that's the way the business will continue to go, and we will continue to try to be ready for the next wave, whatever that is. So without further ado, the core of these briefings is sort of what's going on in markets. Are we in a tailwind or are we in a headwind? And that's kind of the difference, the line of demarcation between, bull markets, if you will, and bear markets. And as I've referred to over the years, sometimes swirling winds. So this is back to that kind of sailing metaphor of, sometimes in a bull market, you can truly throw a dart and it doesn't really matter what happens. And in bear markets, it's a lot harder to do anything right. You get mostly just avoiding not getting smoked in one thing or the other. And so this year has been interesting in the sense that it's really been two subsets of the market that have carried the day. It has been the recipients of this AI capex spend that we've all heard so much about, and the bottlenecks and the shortages in that arms race that these big hyperscalers are spending all this money to go attack this big opportunity that everybody feels is inevitable. That's my first red flag, when everyone feels like something's inevitable. And then in their race to do it, they go out to the supply chain and they try to make a bigger order than the next person so that they could secure a larger amount of supply for themselves. And it creates bottlenecks, and that changes pricing, and it changes economics, and it changes earnings reports. And we've always talked about earnings at the end of the day is the kind of really the beating heart of the market. And as long as earnings can continue to deliver through cycles, then, give or take, things are going to be fine. So what's caught my attention, and I actually sent it in an email this morning to Jackson, I'm sure he's taken a peek at it, is the April to July quarter was a period of time of rapidly rising future earnings expectations. What does that mean? So because of what companies reported in the Q1 quarter reported in April, everyone took numbers up for earnings in the aggregate, like the S&P 500 level, by a bunch. So now forward-looking estimates of earnings in July. So now we'll report Q2 coming up starting this Friday and project into the future what might happen next. Samsung reported today, which I think is a very interesting case in point, where they reported, I think I saw the statistic, they made more money in the last quarter than they did in the segment that they made the money in the last 40 years combined. So that's a pretty staggering thing to ponder. So that's a great report card. That's an A plus on your report card. And what I think those of us who would look forward with, as the market does, are asking is, where do you go from A plus? What's the next? Are we just going to get A pluses every quarter forever, or is this as good as it gets? And I think that's probably one of the prevailing quips of the moment is this as good as it gets for this particular group of companies? And at least last time I looked, Samsung stock on announcing an A plus report card was down 7%, which is an indication that the market's perhaps not believing that it's going to stay this good forever. So time will tell on that. And more importantly and troublingly, in my observation, is the earnings estimates for future quarters are now rolling over. So that is, to me, has been a steady signal of when to play offense, when to play defense, and when to step out of the way. So I'm going to share one thing because I think this is an important statement on how the strategies themselves are positioned. Jackson, I don't know how this is going to show for everyone. Do you see the screen that you're used to seeing?
I sure do.
Okay, great. Okay, so simply put, and I don't know if my cursor will get picked up in this video, but this is the stock markets, all the different stock markets that people track all together, from the S&P 500 to the NASDAQ to the Russell to different indices, international and domestic, and bonds, etc. And as we have always talked about, we have a minivan built for utility over speed on the left, and our sports car, which has done phenomenally well this year, led by Jackson Vickers, on the right. And what we see is, on a day when stocks in general are down, some a lot, some not so much, two of our largest strategies that most of our clients own are actually up on the day. So it always goes back to that question for me, is when people think, oh my gosh, the stock market's whatever, should I do something because of the stock market? I always go back to, well, we don't own the stock market. So it really is a question of, if you're positioned improperly, then we can change the type of ride you're comfortable with. But by and large, I think we are very well positioned for swirling winds, choppy markets, a more defensive position. And so I would signal in this July 2026 video, there will be probably a more defensive tone to things going forward than there has been in a little while, albeit recognizing an outstanding Q2 by you, and to a slightly lesser degree by me. But the strategies do what they're designed to do, which is really what matters the most at the end of the day. So I'll end it there. Jackson, do you have anything you would like to say or add?
Yes, of course. So I'll be
Please.
brief as well, but I think to pick up on an important point that you made, especially referencing Samsung, if you look at where some of the memory in particular, but AI chip and chip adjacent companies are trading, a lot of their valuations remain fairly low. I think that's on the basis of these are cyclical companies. They've been cyclical companies for 30 plus years. In Samsung's case, well longer than that. And I think the market is pricing in the idea that while earnings may be absolutely massive and unheard of right now, how long and how sustainable are those earnings going to be, which is why Micron still sits at, I think, 12 times, a little over 12 times forward earnings. Um, and, if they want that valuation to increase, then they're going to have their own Apple-like moment where Apple jumped from a 10 times earnings company to a 25 to 30 times earnings company when they, introduced services revenue. Um, I don't know if that's going to be possible for the memory companies, but something that we're always tracking. And then, of course, a day like today where, the QQQ is down almost 1.5%, and rates are back up. So 10-year back over 4.5, and then the 30-year back over 5 today. So always keeping an eye on that, especially as we get maturity walls and refinancing cliffs that come in 2027 and 8. So always keeping an eye on that.
Absolutely. And we both know if we should lose the mid part of the curve, then everything will change very, very quickly across a whole bunch
Yes.
of assets. So the best thing, and I was thinking about this morning, there is a bit of comfort in my heart and mind about having been through a CapEx over investment cycle in the tech and telecom space in the early 2000s, and remembering that you think things are can't get any worse, and how wrong you can be. So there will be, I think there will be a moment where we need to change the complexion, at least of our core strategy, pretty drastically from where it is. I don't think we're there today, but I can see a spot not too long from now when the assets will look quite a bit different than they do now. But we don't need to signal that too far ahead of time. So without further ado, thanks again. Happy 13 to Mirador and our team. Far and away the strongest team we've ever had. Super grateful to all of them. The team will likely grow again in the second half of this year. And so there will be other folks yet again running around, which we're super happy. And the recent additions have been very accretive to client satisfaction and firm performance, which is a simple way of saying they're all doing a great job. So that's it for this month, and we will see you guys in August for the next briefing. So I will say goodbye, everybody. Thank you.